Good morning everyone and welcome to Morning Markets from True Potential. Today I wanted to focus in on the Bank of England's Monetary Policy Committee meeting from yesterday and just discuss some of the market moves that we saw following that meeting when we got the result. So if we take a little bit of a step back, what has been happening in bond markets over the past number of weeks has really been a pricing in of interest rates rising in the UK from that 0.1% level that we've been at since the middle of the COVID pandemic last year. That's been priced in, effectively looking at Bloomberg yesterday or a couple of days ago. It was telling us that there was a 100% probability that the Bank of England would increase interest rates yesterday. Lo and behold, we get to the release of the end of the meeting and the conclusions that they've reached, and actually there's no increase in interest rates. So one indication there, the market can be very wrong, but the second, I suppose, thing is how do we think about that? How did the market then react to that expectation being changed? So the Bank of England over the past number of weeks have been signalling their concern around the level of inflation, and indeed their projections show inflation increasing to some 5% for the UK in the latter half of this year. Yesterday they voted 7-2 to not change rates, to maintain them at 0.1. And I think equally surprising, they voted 6-3 not to move on the quantitative easing programme as well. So no real change. That came as a massive surprise to the market, and we saw that reaction in sterling. Sterling over the course of the day weakened 1.5% against the dollar, and even more so within the bond market. And we saw, as you can see in the table that we're just showing on the screen now, that red down arrow showing how yields really came in over the course of the day. If you look at the sort of the 3-year, I think we're talking about yields coming in around 20 basis points. So completely removing that pricing mechanism that had been built into rates. Bond yields coming in like that means bond prices rises. That's a positive. But it also, I think, highlights the concern or the uncertainty, maybe is a better way to describe it, of the market in terms of their interpretation of what the Bank of England has been saying. And that does raise a few questions going forward in terms of the expectation that the market is now pricing in for interest rate increases. Certainly something that we as a team and many column inches will be expanded upon over the next number of weeks, thinking about the direction of UK monetary policy. Looking at other asset markets yesterday, we continued to see equity markets move higher, particularly in the case of the US, where growth continues to be that dominant style, really driving the market forward there, where I think we were 6 days of ongoing increases with the S&P, similar with the NASDAQ as well. Really just building on that momentum that was coming out of October, driven in the main by company results and that expectation being delivered in terms of stronger earnings recovery. Looking to the day ahead, and the main focus turns back to the US today, looking at the October jobless report and just thinking about how important that is in the context of 2 disappointing months basically over the past couple of reports, seeing if we can see an improvement in that employment trend in the US. That's very important because that's one of the key measures that the Fed have been looking at, given that they moved forward with tapering this week, suggestive that we might get a good employment report from the US this afternoon. I'll leave it there. Please look out for the podcast later today and join us again next week on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.